Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data isn't in. Today, we're going to review an article from Redfin that is going to explain how they believe the increased interest rates are going to impact the housing market. Now, a lot of people were caught off guard by the Federal Reserve essentially saying that interest rates will remain elevated in 2024. Now, they shouldn't have been off guard because that's essentially exactly what the Federal Reserve has been telling us after they said that inflation was supposed to be transitory. And something that is very interesting as well is the soft landing is no longer the baseline for what the Federal Reserve is doing, meaning they're now acknowledging that more than likely we will have to go into recession in order for the economy and specifically the housing market to properly reset. And we know this, guys, we know this. Either prices go down or wages go up. And right now, wages are doing the opposite of going up. Adjusted for inflation, wages are actually going down. So again, we'll explore the Redfin article, and then I'm going to take you into a couple other data sets to show you where we're at historically as far as interest rates and just how far and how quickly interest rates actually ran up because it's historical. And please do me a favor, y'all understand I'm not a financial advisor, even though my bio is as a realtor, a loan officer, and instructor in real estate in Texas. So I know a little bit about what's going on. Plus, I got wrapped up in the last great financial crisis, and I don't want that to happen to you. What I want to happen is I want us all to be winners on the other side of this thing because we were disciplined and had self-control right now. But regardless, the name of this Redfin article is Fed projects rates will be higher for longer, upping chance of elevated rates into next year. And we'll look at CME Fed Watch as well to see what the market is anticipating. The Fed increased projection for 2024 and 2025 rates at its September meeting. Though it kept rates unchanged for now, that will likely keep mortgage rates higher for longer. And that's exactly what Jerome Powell said in Congress. I believe that was in the middle of February, right before the bank run started happening. The Federal Reserve held interest rates steady at its September meeting as expected and acknowledged that the U.S. job market is slowing down. But the Fed also signaled that it expects to keep interest rates higher for longer than anticipated, which is likely to impact the U.S. housing market. The reason is not because of higher than expected inflation, but rather that the Fed is expecting the economy to grow faster and unemployment to remain lower than it previously did, probably as a result of the overwhelming fraud from all of the COVID-19 money printing. There are still programs going on right now for COVID assistance that I had no idea about. I mean, there's billions of dollars worth of fraud. I mean, this is insane. This increases the level of interest rates the economy can sustain before those rates start to weaken the economy. But also the economy is strong because of the overwhelming money printing. It's interesting how they keep leaving the PPP and EIDL money printing out of talks about how the economy is doing so well. It absolutely drives me crazy because without that historical unprecedented liquidity injection, the economy would be crashing and burning right now. So the Fed had to prop it up. Let's not forget that. How the Fed changed its stance of interest rates for the next 2 years. They raised interest rate expectations for 2024 and 2025 by only half a percentage point each. That's it. And the market's freaking out. It's just crazy. A major change in their projection. But is it really a major change? Yeah, I don't think a half a point's a major change, but whatever. As such, they expected to cut rates twice next year instead of 4 times as they previously forecasted. That's because they think the neutral rate, the level of interest rates that neither stimulates nor contracts economic growth, known to economists as the R star, may be higher post-pandemic. Duh. This signals to the Fed that they should keep rates higher to achieve their policy goals, whether that is to decrease economic growth to bring down inflation or let the economy hum along once they have achieved their inflation goals. So the target goal is 2% inflation. They don't feel like they're going to get that 2% inflation until 2026, which is pretty much common sense to me. How can this impact the housing market? Higher than anticipated interest rates in 2024 and in 2025 will keep borrowing costs elevated. That could keep mortgage rates and housing costs higher for longer. Higher interest rates also keep the cost of credit card and car debt high, which could cut into potential home buyers' budgets. And car loans and credit card loans greatly impact consumers' purchasing power. I've showed you that numerous times on my morning lives, which, by the way, if you don't go to my morning lives, come to my morning lives. I do it from Monday through Friday at 8:45 a.m. Central Time. What about the rest of 2023? The Fed is projecting one more rate hike this year to keep their options open. They may not hike rates again before the end of the year, but it's better for market stability to surprise investors by not hiking than by making an unexpected hike. It's not clear yet whether another hike in 2023 is necessary, but upcoming key economic reports on inflation and the labor market will help decide. Financial markets currently didn't anticipate another rate hike in 2023 before the Fed's September meeting. Such a move would probably affect mortgage rates. However, given how far the Fed has already gone, another 25 basis point hike is unlikely to impact the economy or the housing market much. And that's true because we have, 500 basis point increase? I mean, geez. What matters more is how long we stay at the current level of interest rates and how quickly the cuts come once they start. And that's exactly right. We need to stay at this elevated level of interest rates and quantitative tightening for as long as possible. The inflation in the housing market has been proven to be incredibly sticky. Now, we were on our way around June of 2022 and we were doing good. Prices were going down. Supply was actually shooting up. And then what happened? A black swan event happened. The bank runs happened. The bank runs forced the Federal Reserve to pump in $400 billion, roughly in a roundabout way, of liquidity back into the banking or financing sector. Now, obviously, that liquidity spread it to other parts of the economy. However, also what happened is the interest rates dropped to the low 6% during that time. And that was right in the front of when home buying season started. So again, we want to make sure and we want to hope that we can stay at this elevated level for as long as possible. And let me show you guys where we're at as far as interest rates from when I made this video. And y'all can see how high interest rates are right now. We're sitting at 7.39%. Now that is the daily average, and more than likely by the time you watch this video, that's probably going to be higher because also right now what's going on is the 10-year is ballooning. I believe we're at 4.5% as of the recording of this video. So everything is going up. It's getting a lot more expensive to borrow money, and that's going to greatly impact not only the economy, but the housing market. And just to give you guys an idea of how far we have come, take a look at this chart from Fred Economic Data. This is a 30-year fixed rate mortgage average in the US. And I want to bring your attention to how low rates got. The lowest was about 2.65. This was in January of 2021. Now it went from 2.65 all the way up to 7. Well, you saw what they're at right now. This is the weekly average. So the weekly average is showing 7.19%, but that is a giant run up in interest rates. We've never had this type of run up in interest rates. They essentially doubled in 1 year. Shocking the market. The market can't properly absorb interest rate hikes when they double. I mean, we all know that, but what is very interesting is interest rates haven't been this high since about December of 2000. You can see that right here. They were sitting at 7.17%. We are at a 23-year high right now for mortgage interest rates. It is absolutely shocking. Now, as far as what the market is thinking the Fed is going to do, this is CME Fed Watch tool. This will be linked in my description if you guys want to follow this, but the market is not really pricing in a November rate hike. It's also barely pricing in possibly a second rate hike in December. But what I'm really interested in, and you may want to follow this as well, is what the market thinks is going to happen all the way in July, because I believe as long as we conquer home buying demand in 2024, that the housing market will reset. The housing market will crash. prices will go down. And according to the market right now, we have about a 35% likelihood that interest rates will be elevated going into July. And that is exactly what I personally want to see. But again, this year we had interest rates go down right around March, and they went down pretty substantially. And that really messed things up for the housing market. And as a result of that, I don't think that the housing market rebounded this year. I think that the rebound this year was fake. It's more like a dead cat bounce. And really all that's happened is the recent homeowners put themselves in a situation to where they're potentially at foreclosure risk. And I'm saying that because if you need to sell your house, like you have to sell your house, and you can't, a lot of times that's going to lead to either a short sale or a foreclosure, both of which are not good. Even if you don't get a foreclosure, say you get a loan modification or you get a short sale, both of those things as well completely destroys your credit and financial strength. That's really what I'm trying to say. Now, if you find a house is cheaper than renting, you can comfortably afford it, and you love it, by all means, go purchase a house. Try to somehow prepare for job loss. Unfortunately, most people can't properly prepare for job loss. Overall, you guys, what I believe is it's still a time of caution. It's still important that we sit back, we increase our purchasing power, and we understand what's going on in our local housing markets. And the other thing is we need to learn to trust ourselves and our own ability to find a great deal. Because remember, don't use your emotion. Use your data. For the last 3 years, people have been using their emotion to purchase real estate, and they're going to pay a very big price. And unfortunately, sometimes the only way you can learn that lesson is by pain. And that is unfortunate. That's how I learned my lesson back in 2009 when I had a foreclosure, repo, and bankruptcy. And I was an industry professional, and it took me till about 2009 just to accept we were in a housing market crash. And the same thing as far as the mentality of people is going on right now. And that is very, very scary to me. In fact, I'm going to say this right now. I believe the prices of homes have the potential to crash harder than they did in 2008, depending on how much bailout the government does. And I'm saying that, y'all, because the bubble this time is bigger. Okay. The equity run up is bigger. It's more unsustainable. It's more of a lack of fundamentals. And as a result of that and other things like PE ratio and what the Federal Reserve is doing, I think we're going to get inventory this year, to be quite honest with you. And we have many places where we're going to get inventory and forced sellings. Look no further than STRs, or short-term rentals. Plus, institutional investors are now net sellers. Also, the long-term rental market is finally this close to deflationary numbers. Not only that, the consumer right now is being absolutely rocked, except in foreclosures, although foreclosures are also increasing along with credit card delinquencies and car defaults. There's a lot going on right now. And I really hope if you're watching these videos, it allows you to be calm on the sideline and even empowered to improve your situation. Now, other than that, guys, if you're out there investing in real estate, you already know I wish you luck, and I hope you win.